Essay 210. Agreeing the terms of audit engagement. Preconditions of audit or premises of audit. There are two preconditions for an audit. Agreement of management that they accept responsibility in preparation of financial statements, regarding internal control system for financial statements, regarding information to auditor, that is access to all information prepared by them, additional information as required by the auditor, unrestricted access to personal for inquiry. And second condition is preparation of financial statements as per acceptable financial reporting framework. A limitation on scope prior to audit engagement acceptance. If management or those charged with the governance imposes limitation on scope in proposed terms, auditor believes that a limitation will result in disclaimer of opinion. Auditor should not accept engagement unless required by law. Engagement letter. It is mandatory to agree terms of engagement with those charged with the governance or management. It shall be in written form, preferably before working, preferably before commencing the work. What are the mandatory clauses in engagement letter? First one, objectives and scope of audit. Second, management related responsibilities of management, identification of applicable financial reporting framework. Next, auditor related responsibilities of auditor and reference to expected form and content of audit report. Expected form means expected format. If law or regulation prescribe terms in sufficient detail, no need to make a regular engagement letter. Explain in letter law or regulation applies and ask management acknowledge it and that they understand their responsibility as given in preconditions. Engagement letter in recurring audits. It is not mandatory to make engagement letter for each recurring auditor. Auditor shall assess whether circumstances require change in terms of engagement or need to remind existing terms. Considering the following factors, in case of change in law or regulations, change in financial reporting framework, significant change in ownership, change in senior management, change in nature or size of business, misunderstand objectives and scope of audit, revised or special terms of engagement, change in reporting requirement. In all such cases, engagement letter need to be revised. Next, change in terms. If the management requests auditor to change the terms of engagement, we need to check general reasons. General reasons shortcut is MCLR. Because of misunderstanding, because of change in need of service, because of lower level of assurance and restriction on scope. MCLR. In audit, we generally give reasonable level of assurance. In review, we give moderate level of assurance. In agreed upon procedures, we give no assurance. So if there is any change in level of assurance, then the terms need to be changed. First, auditor need to examine the reasons. If reasons are justified, agree and record new terms of engagement in writing. If the reasons are unjustified, not able to agree, then continue original engagement letter or withdraw from the engagement. On withdrawal, report to other parties as required by law or engagement letter. Next, lower level of assurance. If the assurance has been changed from audit to review, review to agreed upon procedures, if lower level of assurance is justified, issue report as per revised terms, and in order to avoid confusion, no need to refer to original assignment or procedures. Only if assignment is agreed upon procedure, then explain all relevant procedures in report even if performed earlier. Additional considerations while accepting engagement. Financial reporting framework prescribed by law is unacceptable. Accept only if additional disclosure is given by the management. Auditor will put emphasis of matter paragraph and no use of word fair in opinion. If the above things are not possible, still compulsion by law and financial statements are misleading. Warn management in engagement letter and modify the audit report. Example ISRO report. Next, audit report by law unacceptable. Chance of misunderstanding. Give additional disclosure in audit report. If it is not, if it cannot resolve problem, don't accept the assignment. But if there is compulsion by law, then don't give reference of essays. Law and accounting standards contradicts. In such a case, law prevails generally. Whether legal requirement can be fulfilled by additional financial statements or change in description of financial reporting framework in financial statements, then give clean report. If not, modify the audit report. Example IRDA report.